From the bottom. Got it.
Let's see, duplicate.
When I do that, do you guys still see my screen? Because I have to, I like
Yeah.
move it. Okay, you still see the presentation.
See, it's the same for us.
Okay, cool. That's helpful. Yeah.
Well, what do you think, Ryder? Are we about 5 minutes or so in?
Yeah, I see we have 18
Mm-hmm.
on so far. I'm expecting a few more will trickle in, but I think we can go ahead and kick this off.
Cool. Great. Thank you so much for the invite. I really appreciate the opportunity to step onto your platform here and share what I've gained in this pretty wild ride thus far in real estate. Welcome everybody to this webinar. This webinar here is entitled "How to Develop Real Estate That Builds Wealth and Creates Impact Without Construction Experience." Now, or the actual process of construction. And so many people I've found don't really realize that real estate goes through a developmental process, and getting to the point of construction is really only halfway through the whole process. So I really have been advocating for people to realize that there's a much longer continuum of actually envisioning the project, planning it out, getting it approved with the city, and realizing that that is a completely valid development strategy. And we're calling them entitlements primarily, where you can simply get the zoning approval from the city and sell those rights to the next developer for a very substantial profit, and sell a project that has really a lot of values baked into it in terms of what your vision is for the type of development that your city needs. So the presentation here is really focused on two types of people, helping them build wealth and create impact. It's for beginners to learn how to make money by identifying and securing development opportunities, as opposed to renovation opportunities or investment opportunities, where the objective in that scenario is to incrementally improve an existing asset. Here, I'm really wanting to help people realize that you can actually envision a much higher and better use, something that's actually brand new, something by nature creative, in the sense of actually developing a new type of product or a new type of project on a property that doesn't have that as its current use. And then for the more experienced people, I'm going to help you gain some clarity on how to scale your impact and leverage your efforts in real estate by pursuing these types of development projects. I find that there's a real incredible ability to actually have a greater impact and to develop projects that actually make more money and do fewer projects by pursuing development opportunities, as opposed to smaller investment opportunities. So again, the one thing that I want you to take away from this whole presentation is that the only way to exponentially create value and leverage your efforts in real estate, no matter what kind of real estate you're doing, is by pursuing development opportunities. Now, that the nature of a development opportunity is such that the piece of property that we're talking about is fundamentally going through a developmental process, right? So from A to B or B to C in this little diagram that's drawn here. So every piece of property that you've ever seen was once raw land. Basically, there was nothing on that piece of land, and yet somebody had the foresight to get approved from the city the ability to build a building. And that's really the objective in this first phase of the development process. From there, then you actually seek to build that building that was approved from the city, and then eventually get it to a point of being able to lease it up if it's an income producing property, and hold or operate the property for the long term, or if it's not an income property, sell it after it's been built. But fundamentally, the role of a developer, a real estate developer, is to move a piece of property from A to B or from B to C. And we basically break this down into different types of opportunities. because really A to B tends, and really we're going to call this an entitlement, tends to be a little bit more risky because there's a little bit more uncertainty as to what it is that you're going to be able to actually get approved when you go through the entitlement process. Now, if you start to understand the code, the zoning code, you'll start to realize that it's actually going to be much more predictable. And that's really my objective in taking you through this little presentation here. So the type of development that I'm talking about is actually very particular. So the development process, no matter what kind of real estate we're talking about, if it's out in the countryside or within deep within the city, that process is the same. It tends to be, at least. With what I'm talking about here, I'm advocating for a particular type of real estate development, which we call smart growth. And this is a whole movement where there is a refocus on developing cities and creating greater density and filling in the underutilized land within cities to actually create a more connected environment for people and for just general interactions of our society. Furthermore, we're focused on transit-oriented development, where we believe that by focusing development along transit corridors, like fixed rail, most importantly, we believe that that becomes the highest value real estate out there, because people tend to want to live and work and play close to where the transit or where access to mobility resides. And so this is a bit of a shift away from automobile dependence, but I think the data is pretty clear that people want to actually live in an environment that is highly walkable. And then mixed use development. So it's my philosophy and my belief that a greater mix of uses within an environment creates a higher diversity and more of an interesting experience for people. So the type of mixed use development that we're advocating for is at the building level, where we're really hoping that people have commercial opportunities as well as residential opportunities, which tend to be above, in mixed use neighborhoods as well. Again, promoting an environment where people can work, live, and play in the same area. And then finally, the asset itself, we are really advocating for people to develop buildings that are essentially closed loop systems, where essentially you can put solar on top of a building and generate enough power that is needed in order to power the building entirely. Same thing goes with water and waste too. By creating these closed loop systems, we're creating a more sustainable environment and a more enjoyable experience for the end users, which again is our whole point here with smart growth, is that you can develop real estate that has impact on society, but it also has impact to the bottom line, and is actually what people want. There's no real distinction between this type of development and what people actually want. So this is a bit of a new paradigm, smart growth, although it's a rather old paradigm, because this is how cities throughout our civilization have really developed prior to the innovation of the automobile, really. But we're kind of moving away from what type of development that the United States especially has been doing over the past number of decades, which is really suburban sprawl. There has been a mass exodus out of cities, really kind of thinking that cities are not the place that we want to be in for some reason. I mean, there actually are a number of reasons. Beyond even just the automobile, kind of saying that you can now live and be more spacious in your lifestyle. But again, it really has created this sense of disconnect and has, put us into our cars for far too long in traffic jams, for example. And so again, we're trying to focus on higher density, transit-oriented development in walkable urban places. That essentially sums up the type of development, again, that we're focused on encouraging, as opposed to to suburban sprawl, which has been somewhat of the existing paradigm. Now, the slide here that you're going to see is really the summation of the roadmap, in my mind, for creating value in real estate. Now, again, what I've been talking about is this development process, A to B, B to C. Now, along that process, you have to realize that you can acquire a multitude of different assets, and you can take on once you've acquired those assets, different types of projects throughout that process. And in order to do that, you have to acquire the property with financing and navigate those different financing rounds. And then you also have the ability to exit the deal anywhere along that developmental process. So for example, as I've been talking about, you can buy a raw piece of land or a parking lot or a building that's just going to get torn down, and you can envision a much higher and better use for that piece of property, right? And then basically navigate the process from A to B, and B being that point in the process where you actually have the entitlement to, or the right to develop that property, and then subsequently sell that right to develop to the next developer, who would essentially be buying it at the point in the process B, right? Where they are buying the entitled land and then developing the building on that land and then leasing it up and either selling it or trying to refinance and hold it, which in my mind is kind of the holy grail, right? If you can actually find a piece of property that has development potential, and again, we'll talk about how to analyze development potential, but if you can take a piece of raw land that hasn't been envisioned for a higher and better use, get those approvals, build the building, rent it up, usually you can create enough value throughout the entire development process in order to essentially refinance out your total cost to develop that building and put a permanent loan in place and then cash flow that property with the equity that's been created throughout that whole process. So essentially you're increasing your balance sheet, your net worth, and you're increasing your profit and loss statement, or your net income, with the cash flow that's being spit off of that property. Furthermore, you have other streams of value that you can realize too, such as appreciation and depreciation. And the nature of doing that type of development is fascinating, because you're oftentimes not relying on a market exit, where your risk to develop a piece of property like that is substantially lower, because you're just intending to lease it up, refinance, and hold it. So you're taking lease up and refinancing risk as opposed to sales risk, which in my mind is definitely less risky, as opposed to having to sell something back into the marketplace where values have plummeted. Then you're forced to have to sell in a downer market, which tends to not end great. So this is kind of the development process and the roadmap for creating value in a nutshell. And we'll elaborate more on this process as we go through the presentation here. First, I want to give you a very clear example of a project that I carried out last year, which essentially follows this process to a T. So I found a piece of property about 2 blocks from one of the BART stations in Oakland, California, where I structured a partnership to acquire a 12,000 square foot piece of property, which is pictured here in the lower left. This was a former gas station, but it was zoned, right? There was zoning overlaid onto that property that defined the ability to get higher density or more residential units than were currently there. There was actually nothing there, or there was a very small commercial building with some tenants there who were running a tire shop and a taco stand and a car wash. But it wasn't very productive, and so we actually felt like we could actually get a much higher and better use out of that site by putting a mixed-use building on there. So after we had navigated the environmental assessments and realized that the soil was clean to develop residential on it, we were then able to navigate the development process, get approved a 41-unit apartment project that was designed to be net zero energy, meaning there was a large solar array that was going to be overhanging this entire development, which had an internal courtyard on top. And it was built, it was entitled, again, this is just an entitlement play here. It was approved as ground floor retail with 41 units of wood frame construction on top of that concrete podium that we were planning out with our design team. And so as you'll see here, we were able to design it with an architect and engineers such that really met all of the smart growth principles that I've been talking about. It was within a quarter mile of the BART station, ground floor retail, housing on top, so that mixed use building. We had open space on a rooftop to take advantage of the higher views. We had a large solar PV array on top that was powering electric vehicle chargers in the garage. There was actually minimal parking because of the fact that we were encouraging people to walk to BART or use these sorts of car shares that we were envisioning. And we were also promoting a lot of bike storage and amenities that would encourage people to realize that they can bike rather than have to be dependent upon their car. So all of the social impacts and the environmental impacts that we were valuing and were intending to get put out into the marketplace were realized, and not to mention the financials were extremely strong. So we were able to basically acquire this property for $1.35 million. We were able to then, buy it, hold it over an 18-month period, cover the financing costs, cover the entitlement costs, which were really the architect, the engineers, the surveyors, the city zoning fees that we were going to be faced with to get approval for that 41-unit property, and then just general operations and whatnot. So by the end of it, we were about just shy of $2 million into it for an investment, but we were able to sell it into the marketplace to another developer who was out of state or out of the area, and they were willing to buy it from us for $3.5 million. So that was $85,000 per unit, right? We had said 41 units. So essentially in that 18-month period, we were able to make about $1.5 million by getting approval for a 41-unit project, never touching the site, and simply selling the development rights to that next developer. So this goes to show you that you can create substantial value, especially in an urban market that has a real undersupply of units. Not to mention that this property, we had gotten a bonus density, meaning we had navigated the state bonus density process where we were able to get more units than were approved per the zoning code, and in exchange for a few affordable housing units. The developer who ended up buying it from us actually intended to turn it into 100% affordable housing. So another real win for the triple bottom line, in the sense that we had gotten approval. We were part of the process of getting this type of project approved, which is now going to be turned into 100% affordable housing, which is even more undersupplied in our marketplace compared to even the market rate unit. So a great deal. Let me step back for a second and give you a brief introduction for who I am, because I didn't really do so at the outset. But I'm Chris Porto. I'm the president and CEO of Smart Growth, Inc., which is a sustainable real estate investment and development firm out of Oakland, California. I started the company just about 5 years ago, and have kind of really scaled up from doing fix and flip type of investment opportunities to now larger mixed-use development opportunities. So the company, as I've mentioned, is focused on smart growth development, and these are the kinds of projects that we're taking on in Oakland, California. And now I'm subsequently teaching others to pursue these types of opportunities as well. Prior to starting my company, I was with SunPower, which is a solar energy developer. I was focused on project finance, where I was raising money for their projects. And then before that, I was working at Deloitte Consulting, again, focused on a subject matter very similar here, sustainability and climate change. So my whole career has really been focused on sustainable development. I'm a full member of the Urban Land Institute, which is the largest association for real estate developers around the world. I also went through Fortune Builders, which is a real estate investment network that really taught me how to start in real estate. And again, they started me off on a track of focusing on single-family fix and flips, which I quickly outgrew because it really wasn't aligned with the type of impact that I wanted to be making. And I really wanted to be focused on, not knowing at a time, commercial development as opposed to residential investment. So in this presentation here, I'm going to take you through essentially the 5-step process that I go through each and every deal that comes across my desk. This 5-step development process is essentially, every single time you have to go through each one of these steps when you're actually taking on a project. And even if you're not taking on a project and simply looking to get into contract on development opportunities to start to build up your capital base, to be able to then get to the point where you can do these types of development opportunities yourself, that's also part of this process here. So I'm going to break this down for you in the sense of showing you how to source development opportunities analyze development potential, secure development deals, finance development projects, and manage the development process. And again, every single time I come across any deal, I have to go through each one of these steps to even determine if it's an opportunity, to use the financial analysis to make a decision about whether it's an opportunity worth pursuing, getting something under my control with contracts, getting the resources necessary to close the deal, and then ultimately to create the value. So first step here is sourcing opportunities. Now, again, I'm defining a development opportunity in this way. It's essentially the spread between the current use and the potential use. So take an existing vacant piece of land, and you can see the little chart on the left-hand side of the slide here, breaking down these different types of assets that you could be looking for. And these little indicators here would represent vacant land that has a structure on it that you would essentially knock down, land that has a building on it, maybe an income producing property, but it really has excess land that you can develop, or an existing commercial building that you can fundamentally change in terms of its use. For example, a commercial building into a mixed use building with residential units on top. Or finally, a productive commercial asset that down the road can be turned into a much higher and better use. So essentially, when I'm looking for these assets, I always use the zoning code, or the zoning map, which is in the top left-hand corner for my particular city. And every single city in the country has zoning for the most part. So when you look at the zoning essentially tells you what is the potential for a piece of property in a given area. When you see that there is an asset within that zone that's not currently realized in terms of that potential, if there's a substantial enough spread between what's currently there, think about the former gas station, and the potential use, which was a 33 unit building that eventually got up to a 41 unit building, that significant spread creates an opportunity. Now, I don't know yet if it's a deal, right? But it is an opportunity because something much better can be done. And so when I'm looking at assets, I'm always also looking at the potential project that can be taken on and the building that could be built on that piece of property. And so when it comes to what is the opportunity here, it's really having to define the strategy. Is it a multi-unit entitlement deal? Am I going to convert the asset into condo units? Am I going to split the lot in certain ways to sell off multiple pieces of property? Am I going to do a multi-unit development that will be able to be sold off in individual units? These are all the different strategies that you can pursue in order to create value such that you could sell the rights to actually build that project to the next developer. And so this really requires an understanding of zoning, and it requires an understanding of your market and looking at properties within those zones to figure out if there is something there to pursue. Next step in the process is analyzing potential. And so analyzing potential is really where we start to understand what is the mass that can be built on a piece of property. So forming a mass conceptually by drawing out a picture that says, okay, I can build a 4-story building on that particular property, and that structure can have 20 units inside of it. That is basically defining, using the zoning code, the mass that you can build, again, onto that property. Or even taking the existing asset and saying, all right, this thing can be turned into something else, something higher and better. Then the yield projections come when you start to realize that you now have individual units that you could rent or you could lease up. And so projecting the yield from, say, for example, the residential space and the yield, and when we say yield, it's the gross operating income, or it's the total rents that you can get from the residential and the commercial in a mixed use building example. So when you basically figure out that you can generate a certain amount of rental income and you take out your expenses, you're basically left with the net operating income. And that net operating income is essentially your yield for that future development site. Then, you always have to compare in the way that we analyze development potential, the potential yield with the potential cost to develop that site. And that cost will include the cost of the land or of the property that you're going to be buying as your basis for which then you invest additional capital to get to a point where you now have that operating asset generating that yield. And that takes into account everything, right? Your buying costs, your holding costs, your financing costs, the hard and soft costs, and ultimately the land and the profit that the developer is going to have to earn in order to justify doing that deal. So once you have the yield and the cost based upon the mass that you've defined, you essentially then have to run it through a rather straightforward analysis, but can be a little bit complicated. But essentially you need to figure out what the return is on that cost to developing that building, right? So you take the NOI and you divide it by a cap rate to get a future value, and then you subtract out your total cost in order to get your net profit, right? And your net profit then, is, what a developer needs to justify doing that deal. So using that as the key metric to say, yes, that is an opportunity that I am willing to pursue and take the risk of raising all the money that I need to do it, and then developing it, renting it up, and holding it or selling it. That's really the objective at hand. And so, there's certain key metrics that we look at, as I've said, yield on cost, which are basically the NOI over your total cost. And then comparing that to the exit cap rate is an extremely important comparison. You want to make sure that you have enough spread between those two. And then you also want to figure out, what is your total cost compared to your future value? And that total cost to future value is really the thing that's going to determine whether you can put a permanent loan on that operating asset at the end of the process. So the next step would be to secure deals. And securing deals is really the way that you get to the point in the process where you can actually create money. You can essentially secure value and then pass it on to somebody else once you're into contract as an assignee. And assignment deals still work just as well in this world as they do in residential world. Where I was making a lot of money when I was first starting out and continue to make money from assignment deals. You can essentially do the same thing with development opportunities. And so what you're potentially tasked with doing here is to get the development opportunity into contract and think a little bit more creatively when it comes to structuring that arrangement with the seller. So for example, you can essentially negotiate a zoning contingency into a contract with a potential seller, meaning that you don't have to buy the building or buy the piece of property until you've actually gotten the approvals from the city. And at that point, you've essentially created a substantial amount of value that you can pass on to the next person once the approvals have actually gone through.
Chris, can I interject with a
Sure.
question there?
Yeah.
So the zoning contingents, right?
Mm-hmm.
So you say I want to put in a zoning contingency, a dear seller, so that I can let it drop out of contract if the zoning doesn't get approved.
Yep.
Aren't zoning changes processes that take a very long time? Have you had problems with having sellers that say, hey, I'm not going to wait? Like, have you had locked this up on the contract for X years?
Well, so it's an interesting, and it's a common mistake that people make. They say, oh, I'm going to change the zoning with a piece of property. And that's actually not typically the case. So the zone is what it is. And the piece of property within that zone is just not necessarily realized or living up to the potential that the zoning already states that you can realize. So, you're not necessarily changing the zone. You're envisioning a project on the piece of property within a zone that already allows that use. So it's a little bit different. And if you can start to internalize that and be able to confidently sell that to a property owner, that this is actually not as complicated as you think, because again, the zoning is really just the rules of the game. It's the rules of development. It basically says you can do up to this in, according to the rules. And all you have to do is navigate the approval process. And usually it's not a matter of whether you're going to get approval. It's more a matter of when you're going to get approval. So it's very unusual for somebody to get completely shot down where you don't get anything. You have to be a very stubborn developer if you're going to not have anything get approved at some point in the future, right? So the trick is to really internalize within a given market how long it takes to get approvals for a particular project, and then just navigating the process and staying within inside of the rules. So I'm always encouraging people to realize that staying within the guidelines that the city's already stated, it's going to significantly lower your risk proposition when you carry out a project like this.
So okay, clear enough. I think the word zoning contingency just threw me there.
Yeah, well,
because to me it sounded like you're going to change the zoning, but yeah, you're going to get something approved within the zoning.
Yes, and when I say contingency, it's really just a matter of the sale with the seller is contingent upon me getting the zoning approval. So it's really just a matter of I don't have to close on the purchase until the zoning department has given me the approval that I can build that building after I've worked with my architects and engineers to realize that project.
Okay, clear enough.
Same thing as like an appraisal contingency or an inspection contingency. And what's interesting with what I'm showing here on the screen is that there is a range of deals, a range of options that you can pitch to a potential seller. And it's important to realize that when you are creating value through the administrative entitlement process, you can actually afford to pay the seller more because you're going to be realizing a much higher value at the end of that envisioning process. So when you're talking to a seller and they want a lot more, you can basically find a structure that would accommodate them realizing a much higher value than what they would be realizing if they just sold the property to you outright with no approvals on it whatsoever. So, even to the point where you can partner with a property owner and say, look, you hold the property, I'll invest the money necessary to obtain the approvals, and then we'll split the profits above and beyond, our costs being reimbursed. So it becomes a pretty interesting proposition, especially if you can convey confidently to a seller that you know what you're doing. Okay, so the next point in the process is realizing that once you've gotten it under control, and then you realize that you do not want to just assign the contract, right? And again, you can assign the development opportunity to somebody else, such as myself as a developer, or you can seek to close on the deal and carry it out yourself. Now, your risk proposition is going to increase here because now you're closing on the land and you're committed to covering the total costs of holding that piece of property as you navigate the approval process. And again, if you think back to the example that I gave at the beginning of the presentation, my project, right? It was essentially a former gas station with not much activity on it, and we closed on it ourselves. So the fact that we closed on an unentitled piece of property and were confident enough to navigate that process, that we were, handsomely rewarded for doing so, but we did have a substantial amount of costs that we incurred to buy that property with hard money. And looking at this capital stack here, you have to realize that there's two sources of capital that you're going to have to obtain when you're financing a deal: debt and equity. And realizing how to structure equity deals or for development projects becomes extremely crucial. Debt is something that you can put onto a development opportunity, but most of the time lenders are not comfortable yet in underwriting future value or entitled value because it's not yet realize. It's not yet a hard asset that they can underwrite, or it's cash flowing. So you tend to only get a certain amount of leverage when you're pursuing development opportunities. So that's when equity is really necessary to close that gap in terms of your total cost. And so realizing that you can actually continue to leverage with a different type of equity, which we call third-party equity or preferred equity, where it essentially looks like junior debt, but you are essentially only giving them a preferred rate of return on their money, and then not necessarily sharing in the profits with them. Or you can raise, joint venture capital, joint venture equity, and put a partnership together where you as the sponsor and your partner are essentially taking on the project and then agreeing to split the profits in some form or fashion once the property has been sold and everybody else has been paid off. And so in this, on the charts on the right-hand side, you can see that there's different deal types that you can pursue depending upon if you're partnering or you're doing a deal solo, or if you have to raise outside capital. And then there's different ways to raise a certain amount of cash, split up the equity of the deal to various parties, and either share proportional in the profits at the end of the deal, or formulate some sort of calculation, and we call it a waterfall, where the managers get promoted essentially depending upon how successful the deal goes. And so this is kind of a summation of how to go about raising the type of money that you need to raise in order to take on these types of projects. And again, it's not as complicated as you think. And I work with people to kind of drill this down to their essential elements to be able to confidently sell the people who are going to be investing into your projects as equity partners, essentially. And again, because these deals can be extremely lucrative, the upside to your investors can be proportionally high. So the risk-adjusted return for somebody investing equity with you to do a deal like this can be significant compared to what they're able to get even as a private lender, for example. Okay, and then finally, once you've closed the deal and you've raised all the money that you need to do it, and again, I always tell people that you have to raise enough money to cover your total cost. And that's total cost of holding the asset for whatever period of time that you need to take in order to get the approvals or to navigate the next phase in the process of actually constructing the building. But managing the process, and again, the process can be split up as we've been talking about, right? From A to B, B to C, right? The entitlement process, then the construction process, then the operations process for at least an income producing property. So realizing that there are certain people that you're going to have to assemble on your team in order to carry out effectively a development project is, the first thing that you have to internalize, right? And most of the time it requires a licensed architect and licensed engineers to put a building, to plan or design a building that is going to be attractive enough to attract future tenants to that space that you're putting out there into the marketplace. And oftentimes consulting with brokers and contractors, for example, right? Because whatever mass that the architect is envisioning, it has to generate a certain amount of yield, which your broker can tell you, and it's going to have to cost a certain amount that your contractor can tell you. So you as a developer end up being kind of the orchestrator and the team leader for an entire development crew that you put together to justify doing a project like this. And most of the time it's you making the ultimate decisions, but informed by these people who are participating with you in the process, which all tend to be contractors. They all tend to be, people that are not in-house to you. So you can run a pretty lean operation because you're hiring people for a one-off project, which tends to be nice because you don't, as a developer, tend to have a lot of overhead compared to other companies. Then once you've actually assembled that team, you have to realize that you're not going to have certainty throughout the process, but as you go through the process, you get an increasing amount of certainty as to what you're going to actually be able to develop. And so, oftentimes the process starts with an architect coming and doing some sort of massing study or a yield study that basically calculates how much square footage that you can get out of a property given the zoning parameters, And you can learn to do that too. I teach people how to essentially at a very rudimentary level calculate, with simple arithmetic, how much square footage, for example, you can get out of a property given the zoning constraints that are defined. And then eventually turning it into some sort of pretty mass, like a pretty ball of clay that has a certain number of units within inside of it, and getting to a point of submitting an architectural set to the city that they can then put their stamp of approval on it, depending upon their approval process. Excuse me. On the approval process, on the approval process, you have to realize that depending upon what you're asking for to get approved, you're going to have to navigate these different levels of approval. And so this concentric circle diagram here does a good job of basically explaining that depending upon what the zoning states, you can sometimes get approvals to do something. For example, taking existing commercial space and turning it into work-live units, where you're essentially adding an accessory element of residential space as opposed to building something new. At least in my market, I have and continue to do find these types of commercial properties that can turn them into a unit essentially, but keep them as a commercial designated unit and yet still allow somebody to live there. Or you have to basically work through the planning department and the administration that's been hired by the city to govern its urban planning process, right? So getting an approval, within side of the existing zoning tends to be an administrative process. Sometimes, though, you will have to ask for a certain exception that will trigger a higher level of approval, oftentimes going to a planning commission, which can be elected or appointed officials that are not necessarily city employees, but have a good design eye and good discretion when it comes to approvals for the future of a city. And so that becomes a little bit more of a tricky process, because at that point, it then starts to trigger a public hearing. And when you involve the public, your risk tends to go up, because now more people are getting a say in what type of project gets approved. Finally, the city council may get involved at some point as well, depending upon how substantial of a variance, for example, something that's outside of the zoning, and may be really a change of zoning that would require essentially the politicians of the city to opine on the process. And that becomes again more costly, more uncertain, and involves more people that you may not want to involve, given the fact that it's going to change the risk return profile of your project. Okay, so essentially that is the 5-step process for creating value in real estate without necessarily pursuing construction, right? This is largely, especially in California, an administrative process that you can create substantial value in doing just that, getting the approvals for a higher and better use and selling the asset from there. Now, I'm definitely advocating for people to find ways to take it all the way through the process, but oftentimes you don't have the construction experience yet, and yet you still want to participate in the transformation of your city. And I think entitlements tend to be an extremely interesting way for newer developers to get involved sooner than later. And then oftentimes opens up new opportunities to potentially partner with outside developers with more experience. Okay, so the question is, would this work for you? Let me ask you a question. If you followed what I showed you in step 1 and you identified a development opportunity and contacted the property owner, right? Again, you said, okay, that site there's nothing on it, but it's in a zone that supports 10 residential units. Okay, perfect. There's an opportunity probably there. Contact the property owner and talk to them to say, are you interested in me analyzing your property and coming up with an offer price given the development potential? And then you did what I showed you in step number 2 and analyzed that potential to determine a purchase price that pencils given your and the next developer, if you sell the entitlement, their target rate of return. And then finally, if you were to then take that offer price that makes sense for that land, and then you secure the deal with enough flexibility to either assign it to another developer in your market or not close until after the entitlement's been negotiated with the seller, right? To essentially balance the risk and reward profile, right? If you don't have to close on it and you have the time and you really only have to spend the money unsecured in the short term, then it might actually make a lot more sense rather than having to take the risk of owning that property and paying all of the interest that you would be incurring as the owner, especially with hard money. And then, so once you've locked up the deal, if you did what I showed you in step number 4 and you finance the project 100% with private lenders and equity partners, right? And again, totally feasible. I've done it numerous times where essentially you raise the debt, you guarantee the loans, and then you bring on the equity partners necessary to cover your total cost. And you get to keep a certain chunk of the deal. And then finally, you take what I showed you in number 5 and you navigated the development process and you hired the right professionals that know the process better than you do, arguably, right? An architect that can basically just show you how it's done. And then you kind of follow suit and you make sure that things are getting done at the city to eventually get that approval. Do you think that you could be successful? I think it's not all that difficult of a process if you know how to go through each one of these steps. And again, these steps are not that complicated, but they do require you to internalize a few key things and get a few key tools necessary to actually navigate it. So if you don't mind, I'm going to take a few minutes here to, as we close up before we take questions, to give you an overview of the Developer Academy.
Yeah, go
which
ahead.
essentially is the whole process and the whole training program that I've put together to take you through each one of these steps. So just a few minutes here. So who is this process for? Or who is this Developer Academy for? Really, it's for people who have some measure of real estate experience. You know, it doesn't have to be a lot, but you've either bought a property before, you work for an architect or an engineer, you are an agent or a broker, you have some experience working for another developer, or you're just generally interested in the development of cities, or you own a piece of property that might have development potential. There's a number of factors that would actually want you to understand how to develop property. So the way that the program is structured is that essentially I take you through these 8 core modules where I give you the vision for smart growth development and help ground that into the actual principles and show you real opportunities that arise from this type of development trajectory. I help you understand how to capitalize on real estate development, in particular looking at all the risks and all the opportunities that are presented to you. So really the fundamental economics behind doing deals in these markets. And then how to actually market for development opportunities. Again, it's a very distinct process that I go through, as I was alluding to in the webinar here, of how to actually target those opportunities within those zones. And then probably one of the most important modules is how to analyze the development potential of these deals to ultimately come up with a purchase price. It's not too difficult, but it tends to have a number of variables in there where you have to basically come up with a price that would actually make sense for you to pursue the entitlement and then seek an exit after that, or proceed to the next phase of actually constructing the project. Now, Module 5 talks about how to negotiate different deals depending upon the arrangement with the seller. Module 6 would be structuring deals for the financing, right? Given all those different types of deal structures that you could explore. Module 7 is how to actually secure the entitlements, and Module 8 is on how to determine the pathway to construction. Again, if you don't have the construction experience or if you don't have the balance sheet necessary to secure the future loan to construct the building. So in addition to the core modules, which are 8 weekly sessions that you go through, I have also put together core systems, which basically provide all of the resources to go through each one of these steps in the process: sourcing opportunities, analyzing potential, securing deals, financing projects, and managing the process. And I also give a very deep understanding of what it takes to actually start to build wealth and all the different considerations that you as a developer need to take into account in order to, again, build your wealth and create impact. So as I said, in those systems, there's a number of very key resources that I provide to you. I give you marketing campaigns, multiple touch marketing campaigns for development opportunities in particular, and the language necessary to actually sell a property owner on your ability to create value by navigating the development process. The financial model that I've created, which, you know, my background is actually in financial modeling. I've really drilled this down to allow you to understand the massing implications, the yield, the cost, and the different development strategies that you would have to navigate depending upon the type of asset that you're acquiring and the project that you're going to be taking on. And then finally, the legal contracts. So all the legal contracts necessary to get deals under contract, as well as the contracts necessary to structure partnerships, you know, tenant in common partnerships or joint venture partnerships, or even syndications necessary to actually raise the equity. There's a lot of those resources in there as well. Last year, we did a live event where I interviewed my whole development team, where we talked to my architects, engineers, construction folk, my attorneys, my surveyor, financing people, marketing people, entitlement folks from the city. We basically went through the whole process, and I asked them all the questions that you need to ask the people that you're going to have to engage with in order to take on similar opportunities. I've basically distilled all the deals that I've done. There's about 12 case studies within the Developer Academy, all of which are about an hour long, where I break down in painstaking detail each step of every single deal, the numbers, all of the resources that were needed, you know, surveys and all that kind of stuff, how the entitlement process went, what the exit strategy was. These are extremely valuable in this whole Developer Academy. I've also got a fundamentals program that you get along with the Developer Academy, which are kind of the 5 fundamental components of a development company. And then finally, access to our developer community. So we've got about 50 people, actually probably 60 people now since I last checked, about last week, that have gone through the Developer Academy and are all collaborating now on a private Facebook group and sharing real opportunities and getting access to me to guide them through various opportunities that they're pursuing. So with all of this said, right, the core modules, the core systems, all of those key resources, the panel discussions, the case studies, the marketing, or the fundamentals program, and the private discussion group, easily, and I've made, you know, many 6 figures over, if not, you know, multiple 7 figures at this point in doing these deals. This is a $20,000 offer easily here. This right now is going to be offered at $2,000 for the signature program. It's basically a lifetime access. So as this program continues to unfold over time, more and more content is getting uploaded to the learning platform, which is a very robust learning platform hosted by Kajabi. But if you're interested in joining me in the Developer Academy, you can go to www.smartgrowthdeveloperacademy.com. Check it out there. There's been multiple people who have gone through the program and are already making substantial amount of money from doing these types of development opportunities. So Jimmy is a local Bay Area developer that has already crushed it since he's kind of learned the key secrets that I've helped him realize, and how to actually sell development potential to other developers. So he closed a big deal earlier this year for $600,000 profit. Now that's an extremely rare outlier at this point, but not outlandish by any stretch of the imagination in terms of finding development opportunities. Oliver is another developer who left his he was working for a developer, didn't quite know the full transition path to stepping out on his own. He's since done so, and we've closed the deal already, and he's made $50,000 in the process. So I have a guaranteed satisfaction. I've put so much effort into putting this program together that I guarantee that you'll be satisfied. You'll get your money back if that's not the case. And then finally, I've got a live event coming up on Saturday. So that's 2 days from now in Oakland. That event is going to be a day-long event where we're going to power through all of those core systems that I mentioned here. By signing up for the program today, you get 2 free tickets. So you'll be able to come on Saturday with a guest. You just have to cover a materials fee, and we've got about 250 slides to go through on Saturday, where we actually go very step by step through real opportunity in downtown Oakland.